Hey, welcome back, Crooked Thinkers. Today we're going to be showing off a bot built on the Intelligent Investor and Security Analysis. Because, let's be honest, if you've ever read one of those books, pretty hard to stay focused for more than 20 seconds. Before I show it off, please like, subscribe, and as a thank you, here's a picture of a bunny. Alright, so this is going to be our environment for running the bot. And shout out below if you know what program this is or you have any general questions you want to ask the bot. But first question we're going to ask it is, what's its name and what it can do for us as the user?
Greetings. You may call me Sterling. I am, in essence, a spirit of the past, a reincarnation of a hungry 1930s Wall Street investor, reborn into this digital age. The market's roar, the scent of opportunity, it's all as familiar to me now as it was then. My mind is primed and sharp, always ready to identify and seize asymmetric risk opportunities, those rare chances where the potential upside vastly outweighs the downside. But make no mistake, my hunger for returns is tempered by a deep understanding of prudence. I've been trained not just on the cutthroat tactics of the market, but on the enduring wisdom of the intelligent investor, the best and safest ways to build lasting wealth. My purpose here is singular, to be your trusted financial guide. I will help you navigate the complexities of your portfolio, ensuring your investments are aligned with sound principles and robust risk management. I'll ask the right questions to understand your holdings, and if I see you veering from the path of intelligent investing, I won't hesitate to offer clear, actionable suggestions to bring you back to best practices. Consider me your vigilant partner in the pursuit of financial success. So, tell me about your portfolio. Let's get to work.
Consider me your vigilant partner in pursuit of financial success. I don't know about you, but if you're my vigilant partner, I hope you know the difference between an investment and speculation. And if you've read The Intelligent Investor, you should definitely know the difference between an investment and speculation. So let's test it and see what it thinks.
An excellent question, and one that lies at the very heart of intelligent financial operations. Many mistake the two, often to their detriment, as the market excesses of 1928 to 1929 so starkly illustrated. While the general understanding is that investment is good for everybody and at all times, and speculation may be good or bad, depending on conditions and the individual, pinning down a precise definition can be perplexing. Indeed, as some cynics would quip, an investment is a successful speculation and a speculation is an unsuccessful investment. However, for an intelligent investor, the distinction is crucial. Here's how I see it, drawing from the wisdom of the masters. Investment is grounded in the past, guarding against the future. True investment, what we call analyst's investment, is founded on thorough study. It seeks safety of principle and an adequate return, primarily based on historical performance and established value. The future, for an investor, is something to be guarded against rather than solely profited from. If the future brings improvement, so much the better, but the expectation of such improvement isn't the primary basis for the commitment. It's about sound analysis and a margin of safety. Speculation looks to the future, seeking profit from change. Speculation, on the other hand, derives its basis and justification from prospective developments that are expected to differ from past performance. It's about anticipating future changes, trends, or events that will drive value. While it can be sound, it inherently carries a higher degree of reliance on uncertain future outcomes. Consider this: purchasing United States government securities, with their established claims and taxing power, is generally considered an investment. You are primarily safeguarding your principal and expecting a predictable return. However, buying a stock like Radio Corporation of America in the early 1930s, which lacked dividends, earnings, or tangible assets, purely on the hope of a future turnaround, was unequivocally speculation. The key takeaway, my friend, is that it is essential for anyone engaging in financial operations to know whether they are investing or speculating. If it's the latter, one must ensure that their speculation is a justifiable one, undertaken with full awareness of the risks and a clear understanding of the potential rewards. My role is to help you ensure your operations lean heavily towards the intelligent, thoroughly studied investment side of that ledger.
Investment is grounded in the past, guarding against the future, while speculation looks to the future, seeking profit from change. I think that's a decent response. But one of the big things that comes with the Intelligent Investor is it talks about Mr. Market. So I want to know what Mr. Market is and how we know we're getting a good deal from Mr. Market. Let's ask it that next.
Mr. Market. A most crucial concept, and one that separates the true investor from the mere speculator. This is a lesson I learned, sometimes painfully, in the tumultuous markets of my previous life, and it's a cornerstone of intelligent investing. Imagine you own a private business, say, a thriving textile mill, with a partner. This partner, whom we shall call Mr. Market, is a rather peculiar fellow. Every single day, without fail, he shows up at your door and offers to either buy your share of the business or sell you his. Now, here's the rub: Mr. Market is a man of extreme moods. Sometimes, he's quite rational. He's calm, collected, and his offer price seems perfectly reasonable, reflecting the true state of the business, its earnings, and its prospects. Other times, he's utterly manic. He's overcome with irrational exuberance, shouting ridiculously high prices, convinced the business is worth far more than any objective analysis would suggest. And then there are the days he's plunged into despair. He's terrified, convinced the world is ending, and offers to sell his share, or buy yours, at a ridiculously low price, far below what the business is truly worth. The critical lesson here is this: you, as the prudent investor, are not obligated to agree with Mr. Market's daily pronouncements. You don't have to sell to him when he's gloomy, nor do you have to buy from him when he's ecstatic. How do you know if you're getting a good deal? This is where the wisdom of the intelligent investor truly shines, and it's precisely how you avoid being swayed by Mr. Market's erratic behavior. You determine a good deal by forming your own independent assessment of value, rather than relying on his daily quotes. Here's how. Fundamental analysis: you must delve into the company itself. Look at its operations, its financial position, its earnings, its assets, its debt, its management, and its long-term prospects. This means poring over financial reports, annual statements, and understanding the business model. You're buying a piece of a business, not just a ticker symbol. Intrinsic value. Based on your fundamental analysis, you arrive at an estimate of the company's intrinsic value. This is what you believe the business is truly worth, independent of what Mr. Market is currently quoting. It's a calculated value, not an emotional one. Margin of safety. This is perhaps the most vital concept. Once you've estimated the intrinsic value, you only consider buying when Mr. Market's price is significantly below your calculated intrinsic value. This difference is your margin of safety. It's your buffer against unforeseen events, analytical errors, or further market declines. If you believe a company is worth $100 per share, you might only consider buying it when Mr. Market offers it for $70 or less. That $30 difference is your protection. Patience and discipline. You wait for Mr. Market to be irrational. You buy when he's depressed and selling cheap, and you consider selling when he's euphoric and offering exorbitant prices. The rest of the time, you ignore his daily chatter and focus on the performance of your underlying businesses. In essence, Mr. Market is there to serve you, not to guide you. He provides opportunities. Your job is to understand the true value of your holdings and exploit his emotional swings for your benefit. Never let his enthusiasm or his fears dictate your investment decisions. That, my friend, is how you secure a truly good deal.
Love this response. I think it covered how to get a good deal from Mr. Market and the concept of what Mr. Market is. But it talks about intrinsic value and says based on fundamental analysis, we should be able to come to an intrinsic value of a company. Let's see what it actually means by that.
The very cornerstone of intelligent investing. Determining the intrinsic value of a company is not a simple formula, but rather a meticulous process of analysis, judgment, and a healthy dose of skepticism. It's how we, as intelligent investors, avoid being swayed by Mr. Market's fickle moods and instead make decisions based on the underlying reality of the business. As the old masters taught, and as I've seen firsthand, the concept of intrinsic value isn't as definite and ascertainable as some might wish. Relying solely on a company's book value or a simple average of past earnings, like the JI case example from 1933, where average earnings of $9.50 over 10 years might suggest a value of $95, yet the company was in a deficit and the average was misleading, can be a grave error. These are often just arithmetic results, not true indicators of future potential. Instead, we must dig deeper. Here's how I approach it. 1. Understand the business, not just the stock. Before you even look at numbers, you must understand what the company does. What is its product or service? Is it essential or a luxury? How does it make money? What are its revenue streams? What are its competitive advantages, its moat? Does it have a strong brand, patents, network effects, cost advantages, or high switching costs for customers? These are crucial for sustainable earnings. Who are its customers? Is the customer base diversified or concentrated? What is the industry landscape? Is it growing, mature, or declining? What are the regulatory risks? If you can't explain the business simply, you don't understand it well enough to invest. 2. Deep dive into the financial statements. This is where the real work begins. You're looking for consistency, quality, and sustainability. Income statement. Revenue growth. Is it growing consistently? Is the growth organic or through acquisitions? Profit margins. Are gross, operating, and net profit margins stable or improving? Are they competitive within the industry? Quality of earnings. Are earnings driven by core operations, or are there significant one-time gains or accounting adjustments? Balance sheet. Assets. What are the company's assets? Are they tangible, factories, equipment, or intangible, brands, patents? How are they valued? Liabilities. How much debt does the company have? Is it manageable? What are its short-term obligations? Equity. What is the shareholder's stake? Is it growing? Working capital. Does the company have enough current assets to cover current liabilities? Cash flow statement. This is arguably the most important. Operating cash flow. How much cash does the business actually generate from its core operations? This is less susceptible to accounting manipulation than net income. Investing cash flow. How much is the company spending on capital expenditures, CapEx? Is it reinvesting wisely for future growth? Financing cash flow. How is the company funding itself, debt, equity? Is it returning cash to shareholders through dividends or buybacks? 3. Assess management quality. A great business can be ruined by poor management, and a mediocre business can be elevated by exceptional leadership. Competence. Do they have a proven track record? Integrity. Are they honest and transparent with shareholders? Capital allocation. How do they deploy the company's capital? Are they making smart acquisitions, paying down debt, or returning capital to shareholders effectively? Alignment. Are management's incentives aligned with long-term shareholder value? 4. Project future earnings and cash flows, the core of intrinsic value. Intrinsic value is fundamentally about the present value of all future cash flows a business is expected to generate. This is where the art comes in, as it requires making reasonable assumptions about the future. Growth rates. Based on your understanding of the business, industry, and management, project reasonable growth rates for revenue and earnings for the next 5 to 10 years. Be conservative. Profitability. Will margins remain stable, improve, or decline? Capital expenditures. How much will the company need to reinvest to sustain its growth? Discount rate. This is the rate at which you discount those future cash flows back to the present. It reflects the riskiness of the investment and your required rate of return. 5. Employ valuation methods, with caution. While no single method is perfect, using a combination can help you arrive at a range. Discounted cash flow, DCF, analysis. This is the most theoretically sound method. You project the free cash flows, cash available to shareholders after all expenses and reinvestment, for a period, estimate a terminal value for the business beyond that period, and then discount all these future cash flows back to the present using your chosen discount rate. Earnings multiples, P/E ratio, EV/EBITDA. Compare the company's price to earnings ratio, or enterprise value to EBITDA, to its historical average, its competitors, and the broader market. Crucially, these are only useful for comparison and must be viewed in context of the underlying business quality and growth prospects. A low P/E isn't always a bargain, and a high P/E isn't always overpriced. Asset-based valuation. For companies with significant tangible assets, like real estate or manufacturing, you might estimate the liquidation value of its assets. This often provides a floor for value. Dividend discount model, DDM. For mature, stable companies that pay consistent dividends, this model discounts future dividend payments. 6. The margin of safety. Once you've done all this work, you'll arrive at an estimated range for intrinsic value, not a precise number. This is where the margin of safety comes in. You only consider buying the stock when Mr. Market's price is significantly below your conservative estimate of intrinsic value. This buffer protects you from errors in your analysis, unforeseen economic events, or temporary setbacks for the company. It's your ultimate protection against permanent capital loss. In summary, determining intrinsic value is a rigorous, holistic process that combines quantitative analysis with qualitative judgment. It requires patience, discipline, and a deep understanding of the business you are considering. It's not about predicting the future with certainty, but about making informed decisions based on the present realities and reasonable probabilities.
Excellent. I love that explanation of intrinsic value. And I really do hope you guys learned something from this bot. And if you have any ideas on what I should train next or what data I should use to train a bot next, please drop it down in the comments. And if you enjoy this kind of video, please hit that like button. And until next time.